It's very difficult to digest as well. It's a very complex topic, obviously, the bond market, treasury market, and all of that good stuff. I'm really trying to understand what is happening and maybe explain it to our audience as well. Because when I read the headline, Treasury boosts long-term bond buybacks. They're boosting it from 2 billion to 4 billion. So that's a 100% boost. Okay, we can agree that sounds like a big number, but what does that really mean? Why is the market reacting like that? Then how can we maybe like explain it to me like I'm 5 years old, Jeff? Like how can I make sense of it? How is it not QE, and how is the Treasury Department financing those buybacks?
Well, first, the easy part is the mechanics. The finance of the buybacks is they issue more short-term bills. So essentially, they're issuing more short-term bills than they actually need today. So you need 100 billion in bills, you sell 104 billion. You got 4 billion left over. You take that 4 billion and then you go into the marketplace and you buy 10-year treasuries, let's say, just, specifically 10. It doesn't have to be specifically 10 years. So you got an extra 4 billion because you borrowed more in bills. You buy back 10-year treasuries that are off the run, and therefore you have a buyback program. But what does that actually mean? I know a lot of people are calling it QE because they like to call everything the government does QE or money printing, but it's actually not. There's a purpose behind it, and it's another technical purpose. Now, the reason why the government is announcing it today is, you're exactly right, Kai. There is a sentimental sort of, we want to send a signal that we're paying attention to the long bond and we don't want it to go any higher, because Treasury Department officials are typical economists, typical Wall Street types. They don't really understand interest rates either. So what they're really doing is trying to send a message to the marketplace using a technical function or technical program whose purpose is to provide a little extra liquidity to treasuries that don't really trade. We have this perception of the treasury market as the deepest, most liquid market in the world, and that is true, but that's not true for the entire 40 trillion in debt that's outstanding. It's actually even true for a small slice of it relative to the overall size. So you have off-the-run treasuries, which are treasury securities that were auctioned many, many years ago. So you might have a 30-year long bond that was issued 20 years ago that is now technically a 10-year treasury, but it's 20 years into a 30-year long bond. It doesn't trade. There is no liquid market for a 10-year treasury that's that stale. It's called off the run. And what happens is a lot of reserve managers, whether it be overseas or even just insurance companies and pension funds who have these portfolios of illiquid treasury securities, if they ever force into a situation where they have to sell them, which is more frequent than people realize, then there isn't necessarily a marketplace for the off-the-run treasuries. The Treasury Department several years ago created this buyback program, actually brought back this buyback program. It was used many years ago. So even that is nothing new. I mean, they had this buyback program 20 years ago, and you never heard anybody talk about QE light back then. But essentially the idea here is that Treasury Department adds a little bit of extra liquidity into off-the-run securities so that if anybody has to sell off-the-run securities, there is a ready buyer waiting for them. That's really all it is. But you're right. Why the timing of this news and the 2 billion to 4 billion really isn't all that much either. It's a drop in the bucket. It is definitely made to send a message to really the public more than anything, to try to create this impression that the Treasury Department is on top of the bond market. We hear everybody talking about the 30-year bond rising, and we're doing something about it, even though what they're doing is like I said, a drop in the bucket. And it really, the technical reasons for doing so are legitimate purposes.
What I'm trying to understand, and I'm not a bond market expert by any means, as you can probably tell, but I'm curious, at what price would the Treasury buy back those, out of run bonds that are sitting there? They're probably lower yield because of how bonds have depreciated over the last 20 years, probably worth way less than they were when they were issued back then. So I'm curious, what price are they buying it back for? Just what they're worth today, or are they paying it nominal?
Well, they would pay whatever the market rate is, or very close to the market rate. I'm sure there's some wiggle room, but this is not like it's not like they're buying bonds that are trading at 60 cents on the dollar and paying par for them. It's basically a market rate.
So it's not handouts or anything. I'm just trying to rule out that there's no handouts or anything happening in that regard.
Right. The more interesting question is why the buybacks exist in the first place. And that's because when we enter these periods where dollars become scarce, especially outside the U.S., foreign reserve managers who have these treasuries and reserves for this very purpose tend to sell their treasuries at the same time. And if you have a lot of off-the-run treasuries hitting the marketplace all at once, it leads to volatility in the treasury marketplace because there is not an existing market or is not an existing buyer for all of this old paper. That's really what a treasury buyback is for. And the most the most prominent example of something like that was March of 2020. A lot of what happened in March of 2020, especially in the Treasury market, was all of these reserve managers who were hit with a massive dollar shortage tried to sell their illiquid treasuries at the same time when money dealers were like, we can't buy these things. Normally we would, and we put them as collateral in repo and use the repo funds to pay for the transactions. But they're a bunch of old paper that nobody wants. So the Treasury Department said, okay, one of the ways that we could help out in these situations where especially the reserve managers around the rest of the world get hit with a dollar shortage is to give them some place to sell their illiquid treasuries. And another one is FIMMA. I know you want to talk about Japan and the Treasury Department's involvement in Japan. FIMMA is a Federal Reserve Program, FIMA, which is somewhat the same
right?
thing.
Like FEMA is like the hurricane and disaster relief.
Yeah,
right?
no, not
okay.
FEMA.
Okay.
Yeah, FIMA is the Federal Reserve's way to do basically the same thing we're talking about, except in this case, they're not buying the treasuries. They're using the treasuries, usually illiquid treasuries, as collateral to borrow reserves from the Federal Reserve. So the Japanese, as we know, intervening in the currency market to rescue the yen, or at least to try to stabilize the yen, which obviously is not going to work, and it hasn't worked. But in order to do that, they do what exactly you're supposed to do. They have these reserves of U.S. treasuries. They take those treasuries and they sell them. They take the proceeds from those treasury sales and use those proceeds to buy yen to try to prop up the yen, which works for about 2 or 3 hours, maybe a couple days, at most a couple weeks. So they have to sell treasuries in order to intervene in the currency market, which, again, given the narrative that everybody's running with and the government is interesting in countering, that's not, it doesn't lead to the perceptions that the U.S. Treasury Department of the Trump administration would like people to have. So instead of having the Japanese sell their treasuries on the marketplace and maybe feed further into this idea that bond yields are skyrocketing, we'll have the Federal Reserve activate its FIMA, which has already been active anyway. Anybody can use it. Any foreign government can use it. The Japanese instead will pledge to use their security. Instead of selling them in the marketplace, they're going to use those securities to borrow reserves and then take those reserves as proceeds for intervening in the currency markets. It's really about countering this idea that the U.S. Treasury market is experiencing some disorderly sell-off that signals or heralds, the next era of double-digit interest rates that is just upon us, which again is seen nowhere on the Treasury market or in the Treasury curve.
Did the Treasury Department just open itself up to bullying, meaning like let the bond market, we just blinked, the bond market now knows what it needs to do to have the the Treasury react to what is happening in the bond market? Did they just show their cards?
Oh, I don't. Yes, there's a short-term, small move in the marketplace today. Yields came down a little bit, but it really wasn't all that much. The marketplace knows that this is all symbolic. This is basically symbolic for public consumption. So there's not going to be any long-term effect from bond buybacks. Like I said, bond buybacks are nothing new. The Treasury Department has been doing them for many, many, many years, and they've been in place for the last several years. Really, this is just about creating a news event so that the Treasury Department can say we're doing something about the thing that everybody's talking about, that the market isn't really all that concerned over.
Well, in my opinion, they can keep doing it because gold is up 3.18% as we're talking right now. So I don't mind the second effects here, but yeah. It is interesting because I know we're talking about minuscule numbers, 2 billion, 4 billion. Who's counting these days? It's just a rounding error, but like the effect, like of course, in theory on interest rates, because you're buying back cheaper bonds that the interest is obviously much lower on than, or potentially much lower on. I don't have the exact data and replace it with higher yielding bonds that cost you more, right? But the effects are probably small, right?
It's at the margin. I mean, when you're talking about what is the interest, 1.6 trillion or something, some ridiculously huge number. At the margins, this is a couple $100 million.
Rounding error at best.
Yeah. So again, it makes perfect sense from a symbolic or standpoint of symbolism, because people think, I don't know what a buyback is. It sounds like it's a big deal, and of course everybody's running around saying this is QE light. This is a huge deal because click sell. When in reality, this is again symbolism. But the market, there is a legitimate market need for something like this.
Absolutely. I think we can put a bow around the conversation today. Like, I think it was really important to react to that news event this morning and to help people understand what it actually means, because the market reactions are quite violent for lack of a better term, meaning aggressive. Again, 3.3% up in gold is a big move. The mining shares are up 7% actually, GDX, if I look at it. So that's a quite interesting move higher.
From October 9th through 12th, I'm bringing together a group of roughly 40 serious investors and financial professionals, along with some special guests and friends like Hugh Hendry and Mike Green, George Gammon, Brent Johnson, and a couple of other ones, where we're going to spend 4 days asking the questions that truly matter. What happens next? Where are the biggest risks being mispriced? Where are the opportunities? What should change our minds? And how should we think about positioning around it? This is not a conference built around speeches. It's a small room built around discussion, some disagreement, and actionable advice. So if you manage some meaningful capital or you're seriously interested in all of these questions and finding answers to them in a very small, intimate setting, apply below.